Today is Monday, January 4th, and this is a post-market review for the stock market activities during the first trading day of the year. And what a day it was. We started the day with a gap higher, and then the market started falling down and going down and down and down throughout the day. With that being said, we did manage to close well above the lows of the day. Mixed themes, mixed signals. I will try to do my best in this video to untangle the web for you and give you a clear explanation to what happened today. I will talk about that a lot more during the heat map analysis, and I have the usual for you. The headlines of the day. We'll talk about macro news, sentiment news, Jack Ma, Tesla, and more. And I have the charts for you, the SPY, the Qs, IWM, dollar index, VIX, gold, yields, bonds, Apple, Tesla, but I also have for you a little more today. Kroger, Salesforce, Zoom, and General Motors. Is this the best show on YouTube or what? And of course, we will conclude by previewing the very important critical elections happening in Georgia tomorrow. What are the implications on the stock market from the outcome of the elections? But before we do that, let's discuss how the stage was set before the trading activities for today. We are entering the year with headlines like this. Investors are convinced the stock market party will continue in 2021. Here is more. The S&P ended 2020 trading at almost 30 times profits, meaning it starts a new year higher than at any time since the year 2000. The Nasdaq 100 is at 40 times earnings, a level not seen in 2 decades since the dot-com bubble. Extreme euphoria and extreme valuations. You combine that and you sprinkle a little bit of presidential tweets like this one. Finished off the year with the highest stock market in history, setting records with your 401ks. Just like I said I would. Congratulations to all. Now, if you are a new subscriber to this channel or a new subscriber to life in general, you might have not noticed that these presidential tweets bragging about the stock market are the most reliable technical indicator for market top. They never fail. Every time this guy brags about the market, it shoots out a sell signal. So what is the result of the recipe I just presented to you before we enter 2021? For that, let's go on with the market coverage, and here we go. The Dow Industrial Average closing in the red, down 382.59 points, or a decline of 1.25%. The Nasdaq closing in the red, down 189.84 points, or a decline of 1.47%. The S&P 500 also getting whacked, down 55.42 points, or a decline of 1.48%. And here are the sector's performances for the day. Leading the pack and winning the first, second, and third place, the equivalent of the gold, silver, and bronze, is basic materials, which ironically these metals come from. But we are not going to give any medals to energy or any other sectors because the performances were pathetic, and basic materials is the only sector that managed to close decisively in the green. The laggards of the day are led by real estate, industrials, and utilities. Moving on to the coverage of the futures market performance for the day. And right away, you see crude oil sliding just a little bit, anticipation of the outcome of the elections from Georgia tomorrow. What about softs? Lots of weakness here in softs. We saw coca down, OJ down, coffee down, Lombard down as well. Meanwhile, the cotton futures are muted, while sugar managed to close decisively in the green, outperforming softs futures for the day. We did see a big climb in metals today: gold, silver, platinum, copper, but specifically gold. You're not seeing it right here because the new session already started when I took the screenshot. But trust me and take my word for it, gold was up for the day. What about meats? Declines for live and feeder cattle. Meanwhile, lean hogs charging higher once again. Now, we did see muted action across the board for grains. Depending on which contract you're following, the results may vary. However, grains futures are waiting for the outcome of the US dollar. Further declines in the US dollar will be very good for grains, meaning that food prices will go up and inflation will go up as well. They're all waiting on the outcome of the elections from Georgia tomorrow because it will decide how bad the US dollar is going to decline. Moving on to the big casino, the options market. Let's see what we have here. New year, and the tables are still hot, just like the year before. Number 1, Apple, with a little over 1.9 million contracts traded for the day. About 72% of those were calls. Neo, at number 2, with over 1 million contracts traded for the day. About 76% of those were calls. Tesla at number 3, with almost 1 million contracts. About 58% of those were calls. So again, it's a new year, but we are back to gamble around the same tables from last year: Apple, Neo, and Tesla. Moving on to some of the unusual activities that took place in the options market today. Starting with the ticker SUM. This is for a company called Summit Materials. And they're making a bullish bid here, buying the 22.5 calls, expiration date January 15th, with expectation that the name will climb over 10% by then, and they are paying about 50 cents a piece for this one. And the theme continues with the strength in gold and materials in general. Here we have a bullish bet for the materials ETF GDX, and they are buying the 43 calls, expiration date February 19th, with expectation the GDX will climb over 11.5% by then, and they are paying about 85 cents a piece for this trade. We've been talking about the bullishness in materials for months and months now. Since last summer, I've been telling you, watch out for copper and buy Freeport-McMoRan, FCX. And since then, the prices of copper and Freeport-McMoRan stock surged really high. And you see a continuation of the same theme here from traders in GDX and Summit Materials. And here we have a bearish bet for Fubo TV, and they're buying the 20 bucks puts. The name was down double digits today already, but they are bidding on further 17.5% or more in declines by the expiration date of January 8th, meaning the end of this week. So they are betting on a lot of pain for this name, and they are risking about 70 cents a piece to enter this trade. All in all, by the way, the trade cost over $1 million. And here is another one, a bullish one in contrast, for the ticker VIPS, VIP Shop, Chinese company, and they're buying the 30 calls, expiration date February 19th, with expectation that the name would rally over 6% by then, and they are paying about $1.55 for this particular trade, bringing the total to over $2 million bucks. Here's a bullish trade for Li Auto, and I've been talking about Li Auto as my favorite EV name, and you saw that the stock rallied today. However, these insane moves, up 10%, down 10% another day. I'd rather wait for an overall correction and then accumulate Li Auto in my portfolio. But for now, we can play and enjoy the game and the ride while it lasts via call options. And in this case, this trader is buying the 37 calls in Li Auto. Expiration date January 15th, with expectation that the name would rally over 14% by then. And they are paying about $1.30 for this trade, bringing the total to well over $1 million bucks. And here is the last trade of the day that I'm interested in for General Motors, the ticker GM. And in this case, they're being bearish, buying the 37 puts, expiration date January 29th, with expectation that the name will decline over 9% by then, and they are risking about 60 cents a piece for this trade, bringing the total well over $500,000 bucks. We will cover the chart of GM during the charts analysis. But for now, we are moving on to the headlines that shape the day. And right away, starting with macro news, we had the manufacturing PMI in the morning, and it came way better than expected. Now, That is good news, right? Wrong, and here's why. US manufacturing PMI edged up to 57.1 on substantial increases in output and new orders. That is the good part. Here comes the bad. However, the headline figure was also pushed higher by severe supply chain disruptions. Furthermore, cost burdens and selling prices soared. Pay attention to this one. Selling prices soared as firms sought to partially pass on higher input prices. Are you paying attention or not? Because if you are, what you've understood from this is hello inflation. To all of those inflation skeptics out there, what is that telling you? Not only you're about to see a demand pull inflation in the economy, you're about to see a supply push inflation in the economy as well. A perfect recipe, a perfect storm for a sudden and sharp increase in inflation. What does that mean? Bad news for these very expensive stocks. Because high inflation will mean higher Treasury yields. The higher the Treasury yields go, the further we have to contract these insane valuations in the market. And speaking of demand pull inflation in the economy, we had some news about the savings rates among households. And here it is. Savings rate sitting at 12.9% higher, the most recent peak of 12% in 2012 and the highest since the mid-1982. Again, you're looking at this news and you're thinking, we got the highest savings rate and disposable income ever. What are you worried about, Perma Bear? Stop being bearish and an alarmist. There's a ton of money here waiting in the sidelines to buy equities. Now reach into your pocket and feel for a little bit. Do you find anything? No, you don't. You moron. Because when you combine me and you and Jeff Bezos in the same circle, all of a sudden our quote-unquote disposable income and savings rate is way higher than before. We are way richer than ever. You take Jeff Bezos out of that equation, the picture suddenly looks a lot different. And this is the problem with this kind of lump sum data. But the point to illustrate here is that the haves in this economy have a lot of disposable income to unleash in the economy. What is that going to cause? Demand pull, inflation, sudden sharp increase in inflation. And remember, your boy Jerome, this is not me, told you that as long as treasury yields remain low, you're allowed to gamble in the stock market because who cares about valuations? But what happens when inflation rises and treasury yields climb as well? All of a sudden, valuations matter out of the blue in a market that will get caught with its pants down because it's been ignoring valuations for a long time. Furthermore, let's take a look at the Citi U.S. Economic Surprise Index. And here it is. Major positive economic surprises over for now, says the Citi U.S. Economic Surprise Index, because it is back near pre-pandemic levels after plunging and spiking last year. Now, take a look at the Surprise Index chart. Right around June, we started climbing higher and higher into positive surprise territory, meaning that if you have followed this index by itself, this was the time to become bullish on the market because there are a lot of positive surprises coming up. And indeed, that was the right call because we have seen a lot of positive news surprisingly to the upside, specifically regarding the vaccine. But if you are playing the same game still, we are now trending lower, about to cross to the no positive surprise territory, meaning that the surprise factor here is to the downside, meaning that we are expecting a lot of good news, and any disappointment or any surprise in this case will likely come to the downside. And here is the last bit of macro news that I got for you. The US slaps tariffs on French and German wines, aircraft parts, amid EU dispute. So if you're wondering why your favorite French wine just went up in price, it's not because they got good sunshine that given year. It is because the new tariffs. And if you didn't know, now you know. Moving on to some Fed news, and right away we heard from the Chicago Fed President Evans. And as you know, the market was selling off sharply in the morning. So Federal Reserve Chairman Evans from Chicago felt the pressure to assure the market that the supply of cocaine will not only flow uninterrupted but might increase as well. For new subscribers, the stock market is a cocaine addict. What is the cocaine? It is fiscal and monetary liquidity. And in this case, monetary liquidity is more important because the drug dealer, in this case, the Federal Reserve, can supply an unlimited quantity of the cocaine. And the market, just like a drug addict, will throw a fit and suffer a withdrawal if we see any interruption to the flow of cocaine, aka fiscal and monetary stimulus, into the market. And here it is. Fed's Evans, U.S. economy should prepare for periods of very low rates and expansion of the balance sheet. There you go. Chicago Fed President Evans is saying, hold your horses, you don't need to panic and sell, because we at the Federal Reserve not only going to keep the low rates that we promised you, that we're not thinking about raising interest rates, but we are also thinking about expanding the balance sheet and supply more cocaine to the market. Oh, and speaking of the Federal Reserve and their integrity, here is former Fed chairwoman and the not current, but soon to be current Treasury Secretary Janet Yellen. Here's the headline from Bloomberg. Janet Yellen made over $7 million in speaking fees. Now you might ask and say, what is the problem here? Here is the problem. In the past 2 years, President-elect Joe Biden's pick to be Treasury Secretary, Janet Yellen, has raked in more than $7.2 million in speaking fees from, you guessed it, Wall Street and large corporations. Surprise, surprise. The person you're hiring to protect the bank happens to be the bank robber themselves. This is exactly what's going on, not just in the Treasury Department, but every single department we have in this country. And of course, don't forget that Elizabeth Warren, the progressive queen, has thoroughly vetted Janet Yellen and approved her to be the next Treasury Secretary. How does that rhyme with you, Elizabeth Warren, that the next Treasury Secretary cashed in over $7 million from the same Wall Street corporations and banks she's supposedly quote-unquote tough on? Give me a break. Moving on to some market sentiment news, and let's talk about the Robinhoodians and their current market sentiment. Here is an example from a Twitter user, and I'm not sure if he's a Robinhoodian or not, but who cares? I think you can make that judgment very clearly. And he says, the same thing was said in summer, then in September. Just carefully enjoy the party while it lasts and not get caught with your pants down, middle of the dance floor. Haha, irrationality lasts longer than you ever expect. The euphoria is being turned into arrogance, where retail market participants right now are 100% confident that they can call the top and they will know exactly when the party's over. As if somebody's going to come to their door and knock. The market's about to crash. Please take your profits now. It doesn't happen that way. What if today was the beginning of the end? You don't know that, and you wouldn't know that. You will only think that it's another dip to buy until it doesn't anymore. Market euphoria turned arrogance will lead these market participants to think that every dip is worthy of buying, and when it, quote-unquote, happens and the market finally snaps into correction mode, they will not see it coming. They will see that it's another dip to buy, just like they did back on March 2000 after the pop of the dot-com bubble. And maybe these arrogant market participants need to look at the facts. Throughout history, we have seen the stock market following corporate core earnings, not the other way around. Here we are in 2020 when corporate core earnings are going down, the stock market is actually going higher. Opposite direction of where corporate earnings are going. And this doesn't ring any alarm signal in your head that something is wrong with the market. But I know what you're going to say. Yes, it is a bubble, it is a euphoria, it is a mania, but why not enjoy it until it lasts? Because you don't know when the party's going to stop, you genius. They're going to pull the rug from underneath you suddenly. Take a look at QuantumScape today, down over 40% in a single day. What is wrong with taking profits off the table? Take profits when you can voluntarily before the market forces you to take them unwillingly. And here it is, an update on risk premiums for the stock market. And we saw right away that during the March bottom, that was indeed a generational opportunity to buy stocks because the risk premium was worth it. Today, the risk premium is at the lowest level since the dot-com highs, meaning that taking risk in equities is not worth it anymore. Is this enough of a sign to you, Mr. Arrogance over there, who can time the market, that maybe it is time to get out? No, that's not going to be enough for you. But we also heard from billionaire investor Carl Icahn. And Carl Icahn warns that the market rally could end in a painful correction and is hedging accordingly. But again, what does he know? This is Carl Icahn. He missed out on all the gains, bro, that we've been making last year. He should learn from the Robin Hoodites. We the Robin Hoodites are the new Carl Icahn. I want to see his QuantumScape gains before he talks. Whoops, wait a minute. And here is the last bit of sentiment news I got for you regarding the put-to-call ratio. Remember, I've been covering the put-to-call ratio for a while now, and I told you that we are in historically low reading when we talk about the put-to-call ratio for equities, the lowest since the financial crisis. And what that means is that the market sentiment among market participants is extremely euphoric to the point that they don't see the need for buying protection at all. They're not even concerned about buying any puts to protect their portfolio. That is always has been a recipe for disaster. Moving on to some COVID news. Maybe we can find some good news over there. And no, we don't. Here is the latest. The rolling average of U.S. coronavirus cases edged up in the past week, and on the current trajectory, it could break records again any day. And we also heard from the United Kingdom that they are moving to full lockdown mode to combat the new variant of the coronavirus. Furthermore, we heard from Moderna, and here is the headline. In addition to employees, Moderna said it would offer shots to its board members and quote-unquote, the adult household members of our team. The decision calls into question whether there are loopholes that will allow some people to cut the proverbial line for a shot. Meaning that Moderna has a VIP list here and subjects of favoritism for a taxpayer-funded vaccine. Are you surprised? Can I see your shocked faces? Maybe not. Moving on to the Jack Ma story, the very bizarre development about the condition of Alibaba founder Jack Ma. Here is the headline. Alibaba founder Jack Ma has been missing for 2 months. We know that the Chinese government is heading Alibaba and Jack Ma severely for critical comments that he made regarding the regulatory environment in China. And I've been warning you not to buy the dip in Alibaba because this saga is far from over. There's another shoe to drop here, and the Chinese government is not going to stop until they teach Alibaba and every Chinese billionaire a very harsh lesson of the truth about the hierarchy in China, meaning that the government could impose limitations on how big a certain company can get. Now, do you want to invest in a company with a growth ceiling already? No, thank you. But perhaps here is a clue about the whereabouts of Alibaba founder Jack Ma. Netflix series based on a popular Chinese novel is up in the air after the 39-year-old billionaire Lin Chi, who was set to executive produce it. Hey, do they have better interns here? How about Lin Chi, who was set to produce it exclusively? Anyways, died to or due to suspected poisoning over the holidays. And this is not your garden variety food poisoning either. He wasn't hungover, went over the Jack in the Box and got a food poisoning. This is the kind of food poisoning that ends up with you being dead. And if you want my opinion here, I think that Jack Ma sleeps with the fishes. He disobeyed the Godfather and now he got to pay the price. And lastly, moving on to corporate specific news, starting with Amazon. You've heard about the collaboration between Amazon, Berkshire Hathaway, and JP Morgan to create a health insurance company, starting with their own employees and then expanding beyond that. Well, after 3 years, here it is, breaking. Haven, the Amazon, Berkshire, JP Morgan venture to disrupt healthcare is disbanding after 3 years. And right away, you saw the stocks of CVS, Walgreens bolting higher. And here is more news regarding Amazon. Amazon buys Wondery, setting itself up to compete against Spotify for podcast domination. So even if you're a podcaster now, you have to kiss the ring of Jeff Bezos. Otherwise, you're not going to get a spot to produce your content. I guess regardless of which country we are in, we must bow down to our own Godfather. But here is some sort of a pushback, not for Amazon, but for Google at least. Google workers have formed a union. And this is one of the risks against growth of big technology names in 2021. We're not talking about the regulatory risk, which is increasing by the day, but also from a standpoint of unionization. More voices are being added now to unionize in Facebook, Amazon, Google, Netflix, and before you know it, these unionization efforts, if become successful, will pressure the margins of these big tech businesses. The heydays of just pick a stock out of a hat. If it happens to be a tech stock, it goes higher. You don't have to even do any homework. These days are over. Now you have to be extremely picky when you construct your portfolio. Moving on to MGM Resorts. And here it is. MGM Resorts is making a deeper bet into sports gambling with an $11 billion bid for the owner of Ladbrokes brand. I guess that is in the UK, I'm not sure. But those of you who know me, you know that I used to work in the casino industry in Las Vegas for a company that shall remain nameless. I think you got a clue. And back then, I was telling the executives, the big shots, that we need to concentrate our efforts in sports gambling, specifically online gambling, because that is the future and that is the trajectory of where gaming is headed. The geniuses who are leading Las Vegas casinos disagreed, and they thought that online gambling would never compete with the real thing, and people still want to come down to Vegas and have the experience and blah blah blah. And all they did is concentrate on their margins, hiking up the room rates, hiking up the resort fees, adding up parking fees, all the cute tricks of these morons who have no clue how to lead a casino to begin with. And they led every single casino on the strip to the ground financially. And what do? They move on to the next gig. They become a CEO of another company or another foundation. They get another job and they move on. They cash in their packages, and who cares what happens to the company? This is what destroyed Las Vegas, and MGM Resorts is playing catch up now, and it is costing them a lot, to the tune of over $11 billion. Had they concentrated on the efforts back in the day when they were told to, maybe today they would be leading online sports gambling, not trying to catch up instead. And continuing with corporate news, here is QuantumScape. And QuantumScape happens to be one of the Robinhoodiots' favorite names to invest in. And if you sit a Robinhoodiot for 2 minutes and ask them, what is QuantumScape and why are you investing in the company? They will look at you like you are speaking some foreign language, because they have no clue why they bought the name. And in certain cases, they don't even know what the company does. Somebody feeds them the ticker on Reddit in the morning or TikTok, and that's all they do. And what happened today is QuantumScape stock, after the massive pump that we have seen last year, today we saw the dump down over 40% in a single day. So it took you all these weeks to build up the pump and the gains, bro, but it took one day to wipe you out. This is what I've been saying. This is what I've been warning against, telling you to take your profits from these speculative names and get the hell out of there. By the way, a few days ago, I made a video and I showed you a trader who's betting over 15 million bucks for a decline in QuantumScape. Maybe if you were watching the videos I produce here every day, you got the warning signal and you got out in time. Maybe. I hope so. Moving on to the last bit of corporate news we have today for Tesla. And Tesla reported about 500,000 vehicles delivered in 2020, just short of Elon Musk's target. Now, why is this news? Is this good? Is this bad? What's going on here? Let me put things into perspective for you. In 2019, Tesla delivered 367,500 vehicles. In 2020, Tesla delivered over 499,500 vehicles. What is the problem here? That's good, right? Yeah, it is good. The deliveries are up 26% year over year. But you know what's not good is in 2009, the market cap for Tesla was 45.5 billion bucks. Today, year over year, it is close to 700 billion bucks. So ask yourself a question. If you think you're a genius here, you're just following the Tesla cult blindly. Do me a favor and just ask the question. You can ignore it later, but just ask it. Does 26.5% year over year growth in the entire company's production worth over 1,500% increase in its market cap? Is there anything wrong here? Do you see what's going on? Maybe things are not fitting right. Just try and do that exercise. Maybe you'll get out of the cult. You get lucky and you'll get out. And by the way, I did the math several times here just to make sure that Tesla's market cap increased 1,555% year over year. The number looks too high for me, but again, maybe it was too high when I was doing the math. So please do a second check for me if this number is right or wrong. I mean, at this rate of growth, if Tesla manages to produce 1 million vehicles, the valuation will go to, 10 trillion? Moving on to the heat map analysis, and right away, it is a sea of red with very few exceptions. So let's go through them. And let's talk about the theories for today. You might have heard a lot of theories from YouTubers and CNBC, etc. Everybody's trying to come up with an explanation or a theme of what happened today. I mean, you have a day when most names are trading down, but somehow Zoom is trading about 7% higher. Tesla is trading over 3% higher. Walmart trading over 1.5% higher. Wayfair trading almost 5% higher. And we do have the Chinese electric vehicle makers, NIO, Li, Xpeng, all trading in the green. Meanwhile, everything else trading in the red. Why is Zoom in the green, Peloton in the red? Why is Taiwan manufacturing in the green? Meanwhile, Qualcomm, Broadcom severely in the red. Why is Walmart trading in the green? Meanwhile, PepsiCo and Coca-Cola down big. The answer is the market could be just too hungover from the holidays. There is no rationality today. That could be the explanation. It could be that investors are taking profits across the board for whatever news we had today regarding the vaccines or the upcoming Georgia elections, de-risking from some of the hottest names. In addition, we might have seen some short covering in a name like Zoom that have been declining for days and weeks, way below where it traded at the top. So I'm not going to read anything into the action today except the fact that we have seen a lot of profit taking today. Whether that's going to continue tomorrow or not, I think the Georgia elections is going to be critical to the answer of this question. But going throughout the heat map analysis, let's see if we can figure out if there is a certain theme here by looking at the individual names. Starting with technology. Apple down, Microsoft down, the software names down severely. We're talking about Shopify down almost 3.5%. ServiceNow down over 4%. Trade Disk down almost 3.5%. Unity Software down over 6%. But we see few shining lights here in the semiconductor names, specifically Taiwan and Lam Research, and for some reason, Square is also trading over 1.5% in the green. What about communication services? Netflix down big, over 3%. Google, Facebook, Disney, all down. What is outperforming? Certainly not the new IPOs. Airbnb down over 5%. DoorDash down over 2%. What's outperforming is Pinterest up over 3%, AT&T up over 2%, and Zoom up over 6.5%. Any theme here? Do you find an answer? No, you do not. What about consumer cyclicals? Amazon down, Alibaba down, all the restaurants, the reopening names, cruises, hotels, all getting whacked today along with casinos, etc. But Wayfair trading in the green, eBay trading in the green, Lululemon trading in the green, so did Tesla, NIO, Xpeng, Lee Motors, all the EV names. Is there a theme here? Not really. Moving on to consumer defensives. Walmart in the green, everything else in the red. Why Walmart? Who the hell knows? What about real estate? A sea of red. But we saw the ticker BPY, Brookfield Property Partners, up over 17.5%. Go figure. What about utilities? All trading in the red, exception the outperformer that we've been talking about for days now, National Grid, the ticker NGG. What about basic materials? Big day for copper, big day for gold, big day for Valley. Is there a theme here? Did the dollar collapse overnight? No, it did not. Why materials? Why are they outperforming today? Who the hell knows? Industrials. Defense names down big. Raytheon down over 4%, Northrop down over 3%, LMT down almost 3%, Boeing down over 4, being generous here, 5%. Shipping names down, airlines down, the big giant industrial names down, Emerson, General Electric, Honeywell, all trading in the red. Meanwhile, the big energy names, Exxon and Chevron, managed to close in the green. Likewise, some of the giant pharmaceuticals managed to outperform. Pfizer closing flat, and we do have Moderna bouncing higher over almost 7%. We saw an outperformance here from CVS and Walgreens due to the news I covered during the headlines of the day segment. Walgreens closing the day up over 3.8%. Meanwhile, CVS closing just shy of 2.5%. What about financials? They're getting whacked across the board. Big banks down, regional banks down, credit card services down. But again, for some weird reason, Goldman Sachs managed to close in the green. So again, it is a knee-jerk kind of day. You cannot make a conclusion one way or the other, so you have to wait and see what happens tomorrow. But today we have done significant technical damage, and we have done significant psychological damage for the market to be down this big during the first trading day of the year. Moving on to the rotation trade, and let's see if we can find a theme here. Not really. We've seen underperformance from both sides here. In the stay-at-home names, we see Tesla, Zoom, Zillow, Nvidia, and DocuSign just barely closing in the green. The rest down significantly. Likewise, across the aisle for the reopening names, aka the comeback stocks, they're down big, with the exception of Chevron, the only name closing in the green. There's no rotation out of the rotation. So what was the theme for today? We don't have an answer yet. We might have it very soon as tomorrow. But for now, it is the mystery of what happened today and who was doing the selling. For now, we're moving on to the charts analysis, starting with the SPY from a 15 minutes perspective. Right away, gapping higher. Everybody's celebrating. The Robin Hoodiots are going Naruto style, buying the market in the morning. What do you know? Right away, they flush it down, and they did not stop all the way until lunchtime, 9 a.m. Pacific time. We find a footing there. After all the selling was done, you saw very low rescue volume, but it was good enough to create a bottom for the day and left the markets higher. All in all, it is a very bearish development here. Big reversal, consolidating in a bear flag formation, not even closing above the previous support level of 369.60. What do we see when we shift to a daily view for the continuous contract, the futures contract? And here's what we see. We are still trading in a range, and we've been battling the upper range, trying to gather energy to find out if we have enough footing and support from retail traders to blast the market higher. We did that on Friday. Everybody think that this is the breakout. It is coming. Buy. What happens is the next day, the next trading day, they flush the market down, closing below the upper limit of the trading range. Is this a bearish development? Yes, it is. It is bearish enough? No, it's not. Because until and unless we break the level of 3,600, the market remains bullish. Breaking 3,600 in the S&P futures will mean the end of the bullish trend, beginning of a new bear trend that could take us lower for about 10% or more correction. What about the Qs? Similar story here, starting with a gap higher and then flushing down. All of these dip buyers who bought during the first hour of the day, they got smacked in the face right away. The market flushed down. It did not look at any support or any meaningful level. It only stopped when it stopped around lunchtime, and after that, low volume buying, the selling dried out, and you saw the indices lifting higher. In the case of the Qs, it managed to close above the support level of 308.5. So the Qs is more bullish, if you call it that, when you compare it to the SPY. But all in all, it is a very bearish development for the day, because when we shift to a daily chart of the Qs, we pretty much broke in the trend from the consolidation, but we did not break the support level of 308.5. If we do that tomorrow, that will open the floodgates. And remember, you see all these support lines, and I told you, if we break this trend line, it's not going to go smoothly as before. It's going to go through these support lines like running your fingers through guitar strings. It will be music to the ears of bears, meaning that the correction here in the Qs will be very severe and violent. It's not going to be 2% today, 1.5% tomorrow. No, we're going to go down 3, 4, 5% very fast. And the reason is the steepness of the trend versus how strong the momentum is from the RSI perspective. We are not even as strong as we were back in the summer, not even close. Moving on to the IWM 15 minutes chart. We've been trading in a range, a very defined upper limit, a very defined lower limit. We've been respecting that range along with the support line of 191.5 for a while. Last week, we had a firm rejection from the upper limit of the range. We traded below it, we bounced, we tried to climb, we failed, and today the IWM opened, gapping higher, attempting to climb back the range, but it was yet another failure and flushing down. Another rejection from the lower limit of the range. That was your confirmation right there that that trend is over and we're about to change trends, and it is time to short the IWM. And indeed I did. I doubled down on my TZA, the inverse index for the IWM, and if we break 191.5 and close below that level for the day, I will double down again. Because when we move out to a daily perspective, here is what we see. We see that the damage is done regarding the upward trend. And the best case scenario now for the IWM is to consolidate sideways. But we know after the steep rally for the IWM, all the technical errors from gapping higher has to be resolved by the IWM hitting an air pocket and flushing down significantly. It was down over 2% today at the lows. And if this downward momentum continues to gather more energy, as you're seeing from the RSI, as you're seeing from the MACD indicator, that would mean that as soon as we break the 191.5, we will flush down significantly, meaning that the risk versus reward is in favor of shorting the IWM now rather than buying it, meaning that it is time for holders to think seriously about taking profits off the table, and it is time for bears who've been waiting in the sideline to consider entering a short trade for small caps. Of course, the Georgia elections could tip the scale one way or the other, but all in all, the upward trend in the IWM, for all intents and purposes, is for now over. Moving on to the Dixie, the dollar index. What happened today? We started at the lows, but we closed at the highs of the day, meaning that the dollar index pretty much did not do anything since the last session. Remember, we have a lot of bearishness against the US dollar, including for myself. I am a dollar bear, but I'm not a dollar short, meaning that I have a bearish outlook against the US dollar for the long term. But in the short term, I see that the excessiveness of short bets against the US dollar will fire back, because this oversold rally, as you can see from the RSI, is gathering momentum. And if we have an outcome from the Georgia elections that would panic the market, we could see a massive short squeeze in the US dollar that would take it higher than any of us expect. That would cause a lot of damage in the market, specifically in metals, in materials, energy. All of these sectors will get whacked significantly. So we're waiting and anticipating if the short squeeze event in the US dollar will take place or not. Shifting to gold, and let's see what happens here. Gold had a massive day. So is gold signaling what's about to happen to the dollar index? Meaning gold is right, the dollar index just had a fake out today, and tomorrow it will start crashing again. That could be the case, but I think that gold went a little over its head here, and I did exit my entire gold position. Remember that I entered at the support level of 1800, and my exit target was 1925. As soon as we hit 1925 today, I exited my entire gold position. If it goes higher, it goes without me. Who cares? But if we are going to see the dollar short squeeze event happening anytime soon, gold will suffer. Again, this is why the Georgia elections become extremely important. Moving on to bonds. We did not have a significant move one way or another for yields, the T and X, so we are covering the TLT instead. What we see here is a descending trend channel with a defined upper limit and a defined lower limit. At some point in the life of the descending range channel, we come to an end, and the end is usually signified by a saucer bottoming formation as illustrated on the chart. It could be this one, it could be not. We could have a little more declines here and there, and the saucer bottoming formation comes later. But for now, I am seeing that we are starting to make higher lows, and as soon as we crack above the upper limit of the range, the momentum in the TLT and bonds will shift from negative to positive, meaning the money will flood back to bonds out of equities. And this is why watching the TLT chart is critically important. And to illustrate for you, here it is, the performance between the TLT and the SPY since August. TLT in the green, the SPY in orange, and you see the divorce since since August, TLT going down, money coming out of bonds into equities, but now the divergence between the two is extremely high, extremely wide, and we are likely to see a sell-off in equities where the money will shift back to bonds, closing that gap and shrinking it to a reasonable level. Moving on to the VIX. Here we go. We had a massive breakout here in the VIX. Been telling you that. You see the ascending line in the RSI gathering momentum. I've been telling you in previous videos that I've been putting my money where my mouth is. I'm buying VXX calls. Today was a payout day. We saw that being bullish in the VIX was worth it. And from all indicators right now, the VIX rally has just started, meaning that the correction in the stock market is about to intensify. Rising momentum in the RSI, rising momentum in the MACD indicator, closing above the very critical and important level of 25. The VIX rally has just started. This is my take and my opinion, of course. Moving on to Apple. What do we see here? Similar story, gapping higher, flushing down, bear flag formation, very bearish outlook from here. Hard rejection from 138, the double top, and we see the stock sliding lower significantly since then. What does that tell you? Apple ran out of steam. The rally that we have seen since 113, which I called accurately in this channel by the way, was pretty much built on the iCar optimism and the gamma squeeze from the options market. But as soon as we hit the double top of 138, option riders decided to dump the stock to make sure that the majority of call options expire worthless, meaning that they do not believe that the stock should be trading above all-time highs yet. So are we about to witness another gamma squeeze for Apple to rally further? That would require an insane surge of call options buying in Apple. I don't see that happening. I see the name losing momentum here and trending lower, perhaps breaking the next support level of 125. Moving on to Tesla. And remember, during the quad witching day of the S&P 500 inclusion, I told you that the breakout above the range's upper limit is a fake out. We will go down and try to do it organically via retail investors trading and buying the name via stock or derivatives. And that's exactly what happened. It took a few days, but we managed to close and break above the upper limit of the range. The stock is trading in la la land, and shorting the stock is the recipe for disaster unless and until one of two conditions are met. Number one, reaching the RSI level of 84. Number two, breaking the support of 599. If you see these conditions are met, one of them, but preferably two, both of them, that would be a stone cold shorting signal for Tesla. And it would be an epic correction from that point. Absent of that, the momentum and the bullishness in Tesla goes on. And here are more bonus charts that I'm watching this week, starting with Kroger. And I issued this tweet showing you that Kroger has a bullish breakout from a descending trend line, which usually indicates the end of the bearish momentum and a start of a new bullish momentum. This is exactly what we've seen today in Kroger shares, closing well above the descending trend line and above the resistance line of 32. You see the RSI momentum is rising higher. The MACD has a successful crossing in the histogram, signaling strengthening of the positive momentum. So this is a name, this is a breaking out, and it is a chart that I'm watching this week. Of course, I'm watching the weekly close, whether we're going to close above the descending trend line and all the resistance lines or not. Remember that I own Kroger in my portfolio, and I of course added to my position around the levels of 30.30. Moving on to Zoom. And remember what I said regarding Zoom chart a few weeks ago. Here is a daily chart of Zoom. We have a head and shoulder formation that will take us at least down to touch the trend line in yellow. That is a further 12% declines from this point on. But the name has declined significantly since the top back in October. And indeed, Zoom went down, breaking the trend line, however, bouncing in a rebound today. So what do we see here for Zoom? Obviously, a massive sell-off from the top, and we could see some buying pressure here that would take us above the trend line. That would be the healthy way for Zoom to trade. But again, if we see a rejection from the trend line before crossing it and trending lower, that would be an ominous signal that more pain is to come for Zoom stock from this point on. So we're watching this chart very closely, specifically for the weekly close. Here's another one for Salesforce. And remember, after the Dow inclusion of Salesforce CRM, the name gapped higher and traded in la la land. And ever since, and I told you at that time, that joining the Dow is usually a death sentence, not a reason to celebrate. But again, it is the la la land, euphoric Robin Hood market. And what do? You buy at any news. Good news, bad news, good news, worse news, even better news. What do we see today in CRM? We went all the way back to where we've been trading before the Dow inclusion pump. And it is a clear descending channel here. We are catching support from the lower trending line of the channel and from a very critical support line of 216. I am watching if Salesforce stock is going to bounce in a meaningful way from this point on. It would be an entry point for CRM. However, if we fail and close below the descending lower limit of the range and the support level of 216, that would be an ominous signal that there is more severe pain to come here for Salesforce. And here is the last chart of the day for General Motors, GM. Remember, I bought the name in the summer at around $26-27 along the support line. You see the white line, this is the trend line, the long-term trend line, and at each reaction where the circles are, these were buying opportunities for the name. And since then, you see the massive rally all the way to 46. Now, I exited my GM position at around 41. Now the name is back at the 41 level. So am I buying again? This is the question, and the answer is no. I'm waiting for more pain here, specifically for GM shares to go back to the trend line in white, test it, rebound from it, have a confirmation, and then I will add GM back to my portfolio. Absent of that, I'm not interested. I made my VIG, I moved on, but I remain bullish on the name long term. And now moving on to cover the Georgia elections tomorrow. And this is going to be one of the most important elections, if not the most important ever in the history of the stock market. And the reason is it will dictate the next taxation and stimulus regime in the country. In a very, very critical year in the economy heading out of the COVID-19 crisis in 2020. The market and the economy, for that matter, needs clarity of which strategy is going to be applied in the next 4 to 8 years. Will it be, in the Democrats' case, stimulation via more spending, or is it the Republican way of stimulation via tax and regulatory cuts? Here are the polls, the latest polls for the elections tomorrow. And it is dead even. It could go any way. 50-50. The betting houses are giving it 50-50 chance it could end either way. Very tough to predict here, but remember back during the presidential elections, before the presidential elections, matter of fact, I gave you a list of names that would outperform under a Biden win versus names that would outperform under a Trump win. And this was pretty much spot on. You see the names under Biden, for the most part, managed to outperform the names that favored a Trump presidency. That is, of course, for my analysis and research, is not based on any other opinion. So what do I see here? In the Georgia outcome, if the Democrats win the majority of the Senate, that means bigger stimulus, the likelihood that the $600 payment will be bumped into $2,000. That will be very inflationary and stimulative to the economy, at least on a temporary basis. But the market looks forward, and if this is the Democrats' way of spending more, then the market will be optimistic. There will be another stimulus round, a third one. We technically already had two. If the Democrats win, they'll increase it. It'll be Part 2, 2.0. But are we going to see Part 3, perhaps in September, if the economy doesn't recover as we expect? This is what's going to keep the market going under a Democratic win. However, a Democratic sweep in the Senate will mean a majority overall, which means that the likelihood for increasing taxes will go higher significantly. And that would be bad news for the stock market that expanded the multiples significantly due to low taxes and low interest rates. We have over $3 billion in budget deficit. The Democrats will have no choice to get out of this economic hellhole without raising taxes. Matter of fact, that is the case whether we have a Democratic or a Republican majority. You gotta have to raise taxes. Read my lips. There is no way out via more borrowing and printing from the Fed. $3 trillion for last year's budget alone in terms of deficit. On the other hand, if the Republicans manage to win, the likelihood is the stimulus will remain as is. There is no more stimulus. But the market will rejoice the fact that even if there is an increase in taxes, it will be modest under the Republicans versus the Democrats. So what is the market preference here? Does it like an imminent stimulus, a bigger one, or does it like the gradual stimulation of the economy year over year via lower taxes? Remember that the market is a cocaine addict. It is addicted to the fiscal and monetary liquidity, aka the cocaine. Without both, you'll see the market suffering a withdrawal. Case in point, 2018. The market for our first time in a long time is put under pressure to choose which is more important for the trajectory of the market, a bigger stimulus or lower taxes. If I had to take a bet, I would say that the market prefers a Republican win because we've already got stimulus in the economy and people already received some of the $600 checks that they're sending right now. And what we need to ensure here is the continuation of easing financial conditions in the long trajectory, meaning that lower taxes, keeping them low, is more important than a bigger stimulus. That is at least my read. Now, what are the consequences of a Democratic win in terms of market sectors? Which sectors will outperform? Remember, bigger stimulus mean a weaker US dollar and higher inflation meaning higher yields. Which sectors of the market outperform under these conditions? Industrials, financials, materials, energy, and cyclicals. On the other hand, what sectors of the market outperform when you have lower taxes and higher corporate margins, in addition to keeping inflation and yields as low as they can? Utilities, technology, consumer defensives, and communication services. Meaning that if the Democrats win the Georgia runoff elections tomorrow, we will see a continuation of the current trade that we have seen since post-presidential elections. Materials, financials, energy, all of these sectors have been outperforming for months now. However, the fact that increasing taxes is now of high probability will likely scare the market, spook the market, and cause a correction. I think the market is looking for a Republican win here, and they might get it, depending on where the momentum is. Remember that Trump got defeated in Georgia, so the momentum is in the Democratic side. If Trump and Republican voters feel defeated or the system is cheating them and they opt out of voting, the Democrats will win big. They have the momentum. But Georgia is a traditionally Republican state, and the majority of the momentum happened during a presidential race to replace the current president. Will that momentum continue from the Democrat side? And more importantly, the reason why Georgia flipped from red to blue during the presidential elections is not the momentum from Democrats. It is the fact that suburban Republican voters decided to vote against Trump and in favor of Biden, but that is not a guarantee that they have switched parties. Maybe they're just sending a message to Trump that we had enough of you and we're willing to change. But we want to keep a check against the Biden administration, so we are willing to vote Republican in local elections. The key to defining this election and the trajectory of the market from this point on is on the hands of suburban Republican voters in Georgia. If they decide to continue the theme of voting back during the presidential elections, the Democrats will win. And it will probably be a big political statement that we have Republican voters now switched altogether to Democrats, voting for the president and down the line in the Senate for the blue team instead. I doubt that that will be the outcome. I think that Republican voters in suburban Georgia wanted to send a message during the presidential elections, and that was against Trump. But for now, they will stick with party and they will vote Republican for the Senate race tomorrow. The question is, where is the momentum? If the momentum remains the same as the presidential elections, I think that the Republicans will win here, because those Republicans who switched and voted for Biden will go back to voting to Team Red once again. That is my read and my outlook, at least. It's all I got for you today. I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.